Welcome back everyone. This is the second video for Chapter 9 discussion, and we're starting here with Learning Objective 3, Calculate and Interpret Revenue and Spending Variances. So in the last video, we talked about activity variances and isolating differences in results driven by changes in activity between our expected level and our actual level. Now we're going to try to figure out differences versus expectations after having already accounted for those changes driven by activity. So changes or differences driven by something other than a change in volume. So the way we've used inputs, right, something revenue-wise and how we were able to bill customers, and so on. So a couple things to think about first here. If we compare our actual revenue, so the revenue we actually recorded or earned, versus our flex budget revenue, that reset expectation about what revenue should have been given our actual activity level, we call that difference a revenue variance. Also worth pointing out real quick here, there's a difference between a revenue variance and an activity variance for revenue. So not to muddy the waters there, but we can have a revenue variance by comparing our actual revenue to our flex budget revenue. And we can have an activity variance for revenue by comparing the flex budget revenue to our planning budget revenue, okay, as we did in the previous video. Now, if we're comparing an actual cost or expense to the flex budget cost, call that a spending variance. Again, we're saying these are things that are driven by something other than a difference in activity between those planned levels and those actual levels. So let's get back to Larry here. We're going to continue the example from the previous video. Let's stick Larry's actual results, which we talked about very briefly earlier. He had mowed the 550 lawns, he had billed customers $43,000, and he was showing net income of $6,450. We'll compare that to the flex budget, which is what revenue and costs should have been given his actual level of activity of 550 lawns. Recall that revenue there was $41,250, all the way down to net income was $6,650. So now, starting with the revenue line, we have a revenue variance of the difference between those revenue amounts, $43,000 the actual result versus $41,250 the flex budget result, for a difference of $1,750. Again, the actual result is greater than the flex budget, so we'd say that's a favorable revenue variance. Important to reiterate here that this is something caused by something other than that difference in activity between the expected and planned levels, because we've already accounted for that. So this has to be related to strictly how much we build customers on a per lawn basis in a lot of cases, right? For Larry, right? So he had expected to bill $75. Maybe there was less competition in the market. He was able to charge a little bit more. Maybe he charged new customers more only and was able to take on some new customers this month as part of that 550 total lawns mowed. We don't know, but the point is driven by something other than this change in activity between our expected number of lawns and our actual number of lawns. Similar idea for our expenses. So wages and salaries, the actual spend there was $23,500. The flex budget said it should have been $21,500. So we've got a $2,000 difference. Actual is greater than flex, but this is an expense, so that's unfavorable. Now again, this is not driven by this difference in activity between our expected level and our actual level. So this has to be something else. Maybe in Larry's case, he gave a raise to the helper he has that's part of this variable portion of the wages. Maybe he himself took a bigger salary draw, greater than this $5,000. Again, we don't have that information for this example, but we do know this speaks more to his controlling of costs than those activity variances did. Saying this difference driven by something other than a change in activity. Gas and supplies came in at $5,100. Flex budget said it should have been $4,950. So we had a $150 difference there. That one again is unfavorable since actual is greater than flex. And here, well, especially since gasoline's included, could just be rising prices of inputs. Gas prices tend to bounce around a bit, as you all know, so that could account for a difference there. Equipment maintenance, $1,300 was the actual spend. Flex said $1,650, so that's a $350 difference, but it's favorable because actual is lower than flex. Here we just spent less than expected for maintenance. Maybe we got a break on maintenance by trying some new maintenance provider. Maybe it just didn't take as much maintenance. Things didn't wear out as easily or as quickly than expected. Who knows? And then we can have spending variances for fixed expenses. If you recall, we said we can't have activity variances there. We certainly can have spending variances. So we had a $50 favorable spending variance for utilities. Maybe Duke Power lowered their rate. Yeah, right. Maybe we just remembered to turn the lights off more or something like that. No variance for rent or depreciation. We had spent actually $1,200 on insurance versus the flex budget of $1,000. So there's $200 unfavorable. Insurance companies tend to raise rates on occasion, right? So certainly that could explain the difference there. So bottom line net income was $6,450. Flex budget said it should have been $6,650, so we had a small difference there of $200 unfavorable. Again, we've spoken about the individual line items that made up that overall difference. This does highlight, though, an important point. If Larry or any business didn't take the time to look at, on an individual line item basis, any potential variances and just looked at bottom line profit, you could be potentially missing out on a lot. Because if Larry just looked at his bottom line here, he'd say, oh, well, $200 difference, that's immaterial, right? Who cares? I was very, very close to my expectation with my actual result. But really, we have a couple variances here that are potentially troublesome and some that are potentially illuminating in a positive way. Point being, any single line item that triggers a material or significant difference, a variance, should be investigated appropriately. Right? So here we're talking about this revenue variance. We want to make sure we understand that better. Is this something sustainable? Can we continue to charge higher prices, for example? Same idea with wages and salaries. What caused this bump? Was it just that Larry was getting a little greedy? Do we have to pay higher wages to keep good help on? Is this something we can expect to continue in future periods? And so on. So let's pause there and do a quick check. Let's say TOS Corporation's flex budget cost formula for indirect materials, a variable cost, is 60 cents per unit of output. If the company's performance report for last month shows an $800 unfavorable spending variance for indirect materials, and if 9,000 units of output were produced last month, then the actual costs incurred for indirect materials for the month must have been what? So working a little bit backwards here based on what we know about these variances. Pause the video here, work through this, and then come back for the solution. So those actual costs must have been D, $6,200. What we know is that we had an $800 unfavorable spending variance for this indirect materials, and that would represent the difference between our actual result and the flex budget. Now, we don't know the actual result, that's what we're looking for, but we do have enough information to find out what the flex budget would have showed, and that would have been the cost formula of 60 cents per unit of output times the actual output of 9,000 units, so a total of $5,400. So moving down the line here, that means the $800 variance would be equal to the actual spend minus the $5,400. We back solve for actual there and we get the $6,200. Next up, suppose for Saffron Company, maintenance expenses equal $5,000 per month plus 5 cents per unit produced of whatever they make. Which of the following would not likely cause an unfavorable spending variance for maintenance expenses? Pause the video here, look over these potential answers, and then come back for the solution. That would be C. Production for the period was doubled, and so production equipment needed more maintenance than initially expected. So assuming we have reasonable cost formulas for these things like maintenance expenses, this change in activity should already be accounted for in that flex budget activity level. So we would already be isolating that difference over in the activity variance. So we shouldn't be driving a spending variance by just this change in activity. Let's look at the other possible answers just to make sure we're clear on why those aren't the ones. A said the price of gas used in maintenance machinery increased during the period. Yeah, we could certainly have a spending variance there, right? It'd be unfavorable if the price of gas is going up. B, the maintenance workers union negotiated additional fringe benefits for all workers effective mid-period. If we had to pay some kind of increased labor rate or wage rate for maintenance, then that certainly could cause a spending variance as well. It'd be an unexpected bump in that total cost that wasn't driven by a change in this production volume. That brings us to learning objective 4. We're going to look at all these variances together now on a performance report. So I've thrown that together here for Larry's lawn service. So any kind of performance report of this type should just lay out on a column by column basis these different results. So typically we would show the revenue or cost formulas that would derive the flex budget and planning budget amounts. We'll show the actual results first. That, remember, was the tabulated receipts, essentially, what really happened. In between the actual results and the flex budget, we'll show those revenue and spending variances, since that's what pops out those variances, right? The comparison of actual results to the flex budget. Then in between the flex budget and the planning budget, we'll show those activity variances, since again, that's where those differences come into play. So looking at this all together really helps us get a better picture of where these differences between the actual result, what really happened, and that original expectation in the planning budget are coming from. In other words, we're first showing here on the far right that we're isolating some portion of variances driven by this difference in activity level between our expected level, in Larry's case 500 lawns, and our actual level, the 550 lawns, and then showing differences that are caused by something other than that change in activity. So the revenue and spending variances that are driven by something other than that difference in volume, something like price that we charge of our product, the price of inputs if we're talking about the expenses, or our usage of those inputs, how well we're controlling efficiency in that sense. Let's try another sort of back solve problem here. At Jacobs & Company, indirect labor is a variable cost that varies with direct labor hours. Last month's performance report showed that actual indirect labor costs totaled $5,780 for the month, and that the associated spending variance was $245 favorable. If 24,100 direct labor hours were actually worked last month, then the flexible budget cost formula for indirect labor must be how much per direct labor hour. Pause the video here, work through that, and then come back for the solution. That would be 25 cents per labor hour. So we know that the spending variance there was $245 favorable, and that would come from comparing the flex budget to the actual result. We don't know what the flex budget amount was in total. We do know the actual spend was $5,780. So we're saying the $245 variance would equal our flex budget minus the $5,780 actual spend. That means the flex, if I back solve for that, must have been $6,025 total. I also know that that represented 24,100 labor hours. So the total of $6,025 divided by the 24,100 labor hours means a cost formula of 25 cents per labor hour. A couple other notes here on performance reporting. Non-profit organizations, like universities, for example, can still do performance reporting in much the same way that we've spoken about in this chapter. But it's important to remember that they may get funding, so sort of revenue, if you will, from sources like state funding or some kind of fixed funding, donations, endowments in the case of universities, things that have components that don't move with activity or volume levels. So again, we can certainly do performance reporting much the same way. We just need to make sure we account for the fixed components of that revenue or those inflows as we would with expenses going in the other direction. Similarly, we can do performance reporting for cost centers. And a cost center, we haven't really defined that term formally. It's just a part of the organization that only has costs, so it doesn't generate revenue. Things like information technology support, right, finance, legal, human resources, all necessary parts of doing business, all important parts of the organization, but they don't generate revenue. So we can still do performance reporting for them. We just wouldn't have revenue line items, so we wouldn't have net income line items either. It would just be those cost line items. And that brings us to learning objective 5, prepare a planning budget and a flex budget with more than one cost driver. So in a lot of the examples we've used, we tended to simplify the cost drivers for a particular cost. But in a lot of cases in practice or in reality, organizations may need more than one cost driver to adequately explain how those costs are incurred or driven. So the cost formulas used to put together flex budgets can be adjusted pretty easily to recognize these multiple cost drivers. Let's try one for Larry's lawn service here, just to include some numbers and some drivers. So let's say because the time required for edging and trimming is different for different lawns, that Larry decides he needs to add a second cost driver, and that's hours, for the time required for that edging and trimming. So Larry's going to estimate the additional hours needed for that activity and put together a new flex budget that includes the two drivers, the number of the lawns mowed, and then the time spent there in edging. So here's Larry's budget based on more than one cost driver. Now he's saying his two drivers are the number of lawns mowed, 550 was the actual result there, and then the number of hours spent for trimming, and the total was 100 hours. Now his revenue, he's projecting at $75 per lawn plus $25 an hour for the edging. So he's going to bill the customers separately for that because different people have different needs as far as edging, and they're not going to want to pay maybe a flat rate. Same thing with expenses. Wages and salaries is now $5,000 plus $29 per lawn plus $25 an hour for edging. Gas and supplies, $8 per lawn now plus $6 per hour spent for the edging. So the gas trimmers are burning off gas, hour by hour. Equipment maintenance, similar idea. Now he's saying that's $2 per lawn plus $2 per hour spent for the edging. The more edging they do, kind of the quicker they burn through stuff, more maintenance they need for the equipment and so on. Nothing changed for the fixed expenses because those are assumed to stay the same regardless of activity, and their driver is just, they don't really have a driver because they're fixed, right? And that's really all there is to building a flex budget with more than one cost driver. And there's one more learning objective for this chapter, which was to do a performance report with more than one cost driver. I didn't include anything extra for that because it's just an extension of that regular performance report. It looks identical. The only point we really need to make with this multiple cost driver thing is that I could extend this to as many cost drivers as I feel are necessary. If I wanted to have 15 different cost drivers for any particular cost, or for a revenue item as well, I could certainly do that. Just depends on what I think best describes the incurrence of my cost or the earning of that revenue within my particular business. So these could be extended sort of infinitely. And with that, that kind of wraps up our Chapter 9 discussion video. As always, make sure you let me know if you have any questions, or if you need to revisit any part of this, just back up and do so, and then move on to the practice problems.